So from the start of the Finathon, we have done financial analysis quiz. Then we had different quizzes on, different topics on finance throughout the week, which was on Quizzer Day. On Wednesday, we had a quiz on valuation methods. And this weekend, we have a quiz on investment banking. Right? So as a career, investment banking, what does it entail? And a few problems, right, which you will be solving in the investment banking career. So all those are there in today's quiz. You can check the quiz out after the workshop is done. So that's that will bring us to the end of the Finathon. Obviously, we will be continuing on the finance topics going forward as well. Next week as well, we have several finance topics, including credit analysis, portfolio management, then financial risk management. So these are few topics that we'll be doing on the Quizzer Day. So every day you will have a quiz which will introduce you to the core financial value, and will take you through what it is about and help you understand it better. So that will continue Monday onwards on the finance aspect. Great. So let me. So today we are, as I said, we are going to do financial modeling. Let me quickly take you through a few things on the why and the how part of it, and also I will share some resources at the end of this, along with a few interview questions as well, right? So that's the structure of this thing. Is my screen visible?
Yeah, Suhruta, it is
Yeah,
visible.
sure. Thank you. Great. So a little bit about my background before we start, since some of you might not have been there in the first workshop. So I'm Suhruta Kulkarni. I'm Ahmedabad alumni, graduated in 2008. Then I had worked in NTPC for for a few years before I joined IIM Ahmedabad. Post IIM Ahmedabad, I have worked as an investment banker in Ernst& Young. So it is called as transaction advisory over there because Ernst& Young is an audit firm, right? Then I founded my own finance and strategy advisory firm called as LKP Power Advisors, where I was advising different industries and helping them to raise funds, right? So I've got a long career in investment banking and consulting, and I've raised millions of dollars for different industries and projects. In fact, on yesterday I had shared something on how a financial model, which was built with certain flexibilities, right, and with certain features, helped us to quickly take decisions and help close project for help close finance for a big project, right? So financial modeling that way, it is a very helpful, flexible decision making tool, which I've worked on several of them throughout my entire career, right? Then I also worked at IIM Bangalore for a few years, where I was part of the research and publications team, and I have co-authored case studies which are published at Harvard Business Publishing. A very interesting anecdote from there. So with one of the faculty at IIM Bangalore, whom I was working with, we were writing a case study on marketing, and this was marketing of a social healthcare service, right? Now I introduced financial modeling in that entire case study, and using financial modeling, we figured out what is the cost of the service to the society. So, for example, there is a healthcare. Narayana Netralaya was the organization which was involved. So, there is a certain cost which Narayana Netralaya bears to provide a free service to people. Okay. Now, that's not the only cost, right? Even if the service is free, that service isn't free for people whom it is intended to, right? So, these are all people who are probably daily laborers, who are who are farmers, who are in the rural areas, right? So they have to spend a day or two to come to a certain center and avail this service. There is a cost to them, which is 2 days of their labor, right? So financial modeling helped us to figure out that okay, it's not just about cost of service to Narayan Netralaya, but also cost of service to the people who are availing it. And hence we need to determine what is the cost of service to the society per se, right? And this, because of the analysis, right, which we had done in this case study, this won us a prize at an international level. So we won the second prize from University of Michigan for this case study. right? So this is how financial modeling, right, even in non-finance careers, even in situations which may not require this, can help us make better decisions, right? So just one, anecdote I thought I would share with you, which helped us a lot, not just for, I mean, prize winning was part of it, but for Narayan Nethralaya to service its intended target population, right? In 2017 onwards, I started Go Cracket along with my co-founder Alok, who's an IIM Bangalore alumni. And the whole reason that we started Go Cracket venture is to help people with their careers, and hence the week-long Finathon is targeted towards that. So why finance? I won't dwell much upon that. Just briefly, if you are in a finance career, you have the advantage of looking at a business from a 30,000 feet view as well as from a ground level. Is the strategy working? Is marketing working? Is operations efficient? All this you can figure out, right, by analyzing what's happening, what you should be doing, how you should be formulating strategy. That you can figure out by again doing financial analysis, right, of what could happen if we take up a project X, what will happen if we take up a project Y, right? So strategy formulation also needs finance. So finance is something which for running a business you need it at all the places, and that is what intrigued me in joining finance. And even now, I mean, it still continues to excite me and exhilarate me, right? So that's about why I went into finance. So this is the agenda for today, on why financial modeling, how to build one. So in 2 to 3 minutes from now, we are straight away going to jump into an Excel sheet, right, into a model, right? A little bit on interview questions, and I will share a few resources. A small announcement about Finathon. So as I was saying that in Finathon we started last Saturday with workshops. To those who have not attended last Saturday's session and would like to have a recording for the workshop, we will share details. You can access that recording. Then we have 3 quizzes on financial analysis, valuation methods, and investment banking. All the 3 quizzes are open for everyone to play, and these quizzes will be open till tomorrow, 22nd May. Right? Tomorrow night, all the quizzes will be closed. And this is the financial modeling workshop, which we are part of right now. Again, as I said, next week, every day, we have quizzer day, which is short 5 to 6 questions per quiz, which will introduce you to a specific topic in finance and will help you understand that better. Great. So why financial modeling? Let's quickly look at that. So definitely for all of you, I'm assuming that all of you who are present here today, right, are interested in finance. Guys, you have to just excuse me. I'm a little bit under the weather, so there is, little cold and cough. So I will take little breaks in between. So why finance career? I mean, people who are interested in finance careers, right? Be it careers in PVC, investment banking, equity research, you need to be extremely hands-on with financial modeling, right? There is no escaping that for careers in these domains, right? Similarly, portfolio management, right? If you're part of a mutual fund, right? Then how are you going to manage the entire portfolio for your fund? How are you going to figure out what assets to retain, what to sell off, right? So portfolio management or in asset management companies, if you're working in that, you again need to have expertise in financial modeling. If you're working in corporate banking, right? So typically Axis Bank, Kotak Bank, they have something called as corporate banking, which deals with corporates, right? With organizations and provides them with project finance or probably working capital finance. There again, you will need to be hands-on. So typically there, the corporates will prepare a model and give it to you, but the banks typically have their standard format for evaluation, right? So here you are using financial modeling to evaluate on the strength of the corporate's projects and whether you will be repaid your principal and interest on time, right? So that is what happens in the corporate banking. Then in corporate finance, right? So let's say you're part of the corporate finance team of an organization. So as I said, I mean, figuring out, deciding whether to go for a project A or project B based upon its, payback period, based upon the return on investment, based upon what IRRs it is providing, figuring out what cost of capital that you are incurring. So all these things will be part of a corporate finance role, right? So for finance careers, knowing financial modeling is a must. Similarly, for some of the non-finance careers as well, it would be great if you have the knowledge of financial modeling. Now, here you may not need to be hands-on on financial modeling, but you having an understanding of a financial model helps, right? If an analyst gives you a model and says that we have based the decisions on so and so, you knowing it and understanding is very important. Be it strategy formulation, be it business development. So typically, let's say that you are in part of an infrastructure company and part of the business development team over there, right? Then if you're bidding for, let's say, large government projects, be it a toll road or be it a port project or airport project, you will need to be able to you will need to build models for either tariff bidding, for revenue sharing. So this is again where you will need an hands-on financial modeling. Then it could be also project management, right? That you're say managing a project and it's a large long-term project, right? Now in in these kind of projects, it is very easy to kind of put a lot of resources, right, and start getting project done. But is it making financial sense for the organization? Again, there a basic financial modeling to ensure that your project management is ensuring returns for the organization will help you. So thus, for finance careers, definitely you need financial modeling, and for non-finance careers, it is good to have a knowledge of the same, right? So let's get into now the how part of it. So I'm going to present. I'm going to present a financial model itself. And we will share a link where then we can share this model with you guys as well. So we are going to share this model with you so that you can also get hands on with this. Great. Is my screen visible with the Excel sheet?
Yeah.
Elena? Okay,
Yeah,
great.
it's visible.
Yes, ma'am, visible.
Great. So this is, so as I said, I mean, this session is more hands-on on the modeling part, right? So this is, let me give a little bit of background on this financial model. So this financial model has been built to raise funds for a solar power project, right? And the funds could be raised from equity investors. The funds could be raised from debt investors, right? So people, banks basically, right, who will lend to this project, right? Now, if you look at the structure, right, of this, let me zoom it. So if you look at the structure of this model, right, the first page of any financial model. So this is what I will call as a page, right? I mean, this Excel tab is called, we call it as page in the financial model. This is assumptions. You could also have something called as a cover page, right? I have kind of combined both of them, and this is a real model, right, which we have used to raise funds, right, for this project. Obviously, I've masked a lot of details and all that, but this is a model which we use to raise funds. So the first page is assumptions page, right? And this is one of the most important pages of a financial model. Okay, and I will come to the details of it. Then the second page, right, of this model, this is project cost and means of finance. So I'm just going to remove all this formulae later on. So this, I will also kind of explain what this is about. But briefly, because this is a project, right? It's an infrastructure project. I want to see how the project is getting built, and hence how do I need finance based upon the project timelines. And this is why I have developed this sheet. I will come and explain to you in detail. Then the third sheet is about P&L. So this is an income statement basically, where I have my revenues, where I have my expenses. Now, and then I calculate the different margins, right? Ebitda margins, the PBTs, the PATs, etc. Right? Now, this is since this is a solar project model, and we have just 2 or 3 revenue sources. So I've kind of combined, and the expenses are also very less, right, in terms of the complexity. So I've combined all of this in one sheet. For complex projects, you might want to have an income sheet and an expense sheet, and then pull all of this in the income statement. This also could be built. So that's also a possibility, which some of the models have that. Then there are some inflows to the income statement which come from tax sheet. Okay. Now, why do I have a separate income tax sheet? I could as well, right, do a 30%, right, on whatever my profit before taxes. I can simply do a 30% on this and calculate the income tax. However, the rules and regulations of the land, right, India, right, I mean, it has an income tax authority and it has a company act. So the company act tells me that the taxes, you should be taxed at 34%, I mean 33% or something, right, with the cess, this, that, blah, blah. While the income tax tells me multiple things. Okay. So one, it tells me that if you're not a profit making entity, if you're a loss making entity, you don't need to pay taxes, right? Which is given. Then if you are making profit at an EBITDA level, there is some different type of tax that you need to pay. If you are an infrastructure company, right? So there is a section 90I, right, under income tax. Then you have a tax holiday for 10 years. Okay, so there are multiple things which govern the actual tax, and hence it is advisable to build a tax sheet, right? I will take you through what all details that we have on the tax sheet. Similarly, from the income tax perspective, right, on the tax, you can reduce, I mean, you need to add back the depreciation as well, right? So that is where some, and then depreciation also has different rules as per Company Act and Income Tax Act, right? So that is where it is advisable to build a separate tax sheet. Then we have something called as a loan or debt sheet, right? Which is basically figuring out how your loan repayments will be over a period of years, what would be the interest repayments over a period of years, and if required. So in this case, because we were approaching multinational banks and Indian banks both, and we had the we could have had the option of a different loan repayment structure. So typically, if you take a loan for 10 years, let's say that you take a loan of 100 rupees for 10 years, you will typically repay 10, 10, 10, 10 rupees every year, right? That is a normal loan repayment structure. Sorry, just give me a minute. But we have the option to repay the loan as per the revenues that we are getting. So the revenues in the first few years are low, while going ahead it is high. Hence we said that we will repay the loan accordingly, and this is called as ballooned repayment structure, right? And there could be different structures for this also. And then we have our cash flow statement, where we look at the sources of cash and uses of cash. We have the balance sheet, which we have some ultimate checks over here, right? Whether the balance sheet is balancing, not balancing. Then we have the return sheet. So returns, again, we need to calculate returns for both. For your equity investors, this is what we have over here. Depreciate, I will talk about that in a moment. And then, because the objective of this financial model is to raise funds, every time that we go to any investor or to a banker, they need certain project details, right? What is the cost of the project? What are the means of financing that you're using? If you're taking a loan, then what is the interest rate on the loan? What are your project returns? What are your key expenses, right? So for example, my key expenses are operations and maintenance. How much are these are in terms of your project cost, right? So they need certain at a glance kind of information, right? Which we prepare in this model. Why? Because it could happen that you keep changing your assumptions as and when you progress in the project, and also if you are approaching different investors, you might want to have different assumptions. Now you don't want to sit and write it down in a Word document again, right? And hence what we do is that we prepare this in this Excel sheet so that we can simply copy paste in the project document, right? Which is something called as an information memorandum, which we prepare to take to the lenders or to the investors, right? So that is what goes to the information. So here you can see here, I have mentioned as IM info. This is information memorandum info that will go into my IM. And then this is something called as lenders presentation. Now lenders are not worried, right? I mean, whether your project makes you enough money, right, as an equity investor. Lenders are worried for certain ratios called as DSCR or coverage ratios, and they want to see that, right, whether my loan is getting repaid and whether my interest is getting paid, right? They are just worried about that. So for lenders, I need to show something else, right? So this is what, again, now the type of sheets or type of pages that I have in the model will differ from an industry to industry, will differ for the objective that you're looking at. Not all models will be as complicated as this. Not all models would be as simple as this, right? So this is kind of an intermediate model. There are models which are multiple pages, right? Especially the road toll projects that we have, right? Because we have to run so many scenarios in the financial model, and the challenge that we face with an Excel sheet is that the Excel hangs, right? I mean, in different scenarios. I mean, this happens with financial models multiple times. So one quick advice, right, from a practitioner perspective, whenever you're building a financial model or running any sensitivity analysis on that, save, right? Every step here that you do, save the model. Put it in different places on your email, in a hard drive, somewhere, right? So that your model doesn't crash. That is very important because it takes time to build a model, and it's very easy, for Excel to crash it at any given point of time, right? That is why. Let me take a pause over here. Any questions so far? Before I jump into the details of the modeling and how do we go about it, any questions so far?
There's one question in the comment section by Rohan.
Sure.
Yeah.
How to calculate and all those P&L taxation? I don't know how to do it. Sure, Rohan, we will take you through that. Please share us it in Excel sheet form. Yes, Harshan. So after the workshop is done, we will share this model with you guys, right? And post that, you can play around with this model. So the term that we use, that you can't build a model, right? You can't build a financial model unless and until you know what it is. And you can't become an expert in financial model unless and until you build it yourself. So while I will give you the model to play around with it, right, to figure out, okay, if this happens and what is happening, etc., to get a hang of it. But you need to start building the model, and we will have a course on this, on building a financial model, which will take you step by step, right, through how to build your easy financial model, right? So we'll do that later on, right? Cool. So let me now jump into the financial model. Great. So let me walk you through the assumptions sheet first, right? Now, where do the assumptions come from, right? So typically the assumptions will come from the project owner, right? Or the organization where you're working with, or you might also have to do some research. So again, do not take anything which a client gives to you. So as an investment banker, right, I mean, clients will give you information which they are okay with, right, which they feel is good enough. But as an investment banker, you are their advisor, you are their ears and eyes, right? So you need to do your own research, and typically with experience you will know the thumb rules, right, of a given industry, right? So here, what I have started with, right, in the assumptions is the location details. Now, why location details is the first thing? Because this is a solar power project, right? For a solar power project, it is very important to know the location. That is how your solar radiation and hence power generation gets affected, right? That is why this is my location details is the first thing that I've mentioned. So then typically, say everything that, every assumption that you, every input that you have for the model, so this is also called as an input sheet in some cases. You also need to make it modular. So what I've done here is, so I could have simply put that I need 100 acres of land, right? But what I've done is per megawatt, how much land I require. Now this will help me that tomorrow if I change this capacity, So this is 20 megawatt capacity. Tomorrow, if I change this 20 megawatt to 40 megawatt, right, my land requirement will proportionately go up. If you think that this should not be proportionate, right, then you can put a discount factor and you can model that additionally over here itself. So every input that goes into the model should be modular, right? Try to break it down as much as possible. Again, if you look at the structure of this, right? So whatever here I've used a light green color, typically people will use a gray background, right? Or they might use blue input color. So all the inputs, right? Whatever are hard coded things, whatever is not formula based, has a separate color so that you understand that this is a hard coded input. We call it as hard coded input, right? So this is something which you need so that you identify, right? Because once you build a model, right, you won't be able to figure out what is an input, what is an output. Whenever you are, so for example, in the financial assumptions, I've put equity as 30%. So equity is my hard coded input. And because of the project structuring which I had done, remaining for me is debt. So this 70% is not a hard coded input, right? So if I change equity to 20%, my debt automatically becomes 80%, and all my results accordingly also change, right? So this is how your model should be, that you should be able to change or put the relevant inputs and your output should change accordingly, right? So that is one input. So this is what we have in the location details. Then now we have built here, right? The one option that is I can own the land, right? I can buy the land. Second option is I can even rent land, right? So typically, if I decide, okay, 5 megawatt, I don't want to put it on a ground, I will put it on rooftops, right? I will rent rooftops and I will put it over there. So as a modeling perspective, I have modeled that as well. I'm not using it, but I've modeled that as well, right? That okay, if I have to put it, if I have to take space on rent, I have that ready in my model, right? Then we have the system details, right? So like what's the capacity, then what's the capacity of each module, what kind of module, and then what is annual degradation. So again, this is important from a solar project perspective. So solar modules, right? Today, if they're generating 20 megawatt hours of electricity, 1 year down the line, they will degrade and they will, do 20 into 1 minus 1%, right? 99% of the capacity, right? So now, as I said, if you're building a model for a startup which is in the edtech space, right? The metrics that you are going to look at is probably the amount of time spent on a given course. The expenses could be how are you going to rope in teachers to build a course? What is the technology spends that you have? What is the marketing spends that you have? What are the social media marketing spends? So based upon different types of industry, this entire structure will change, right? This is for solar power project, right? Where, see, in this, there is no marketing involved, right? For a solar power project or for any power project, there is never a marketing expense. Why? Any answers on why? That for a power project, there typically is no marketing expense. Okay, so let me answer that. So see, typically, power is typically sold to government institutions, right? Which is a transmission company or a distribution company, right? So there is B2B element involved. So I'm not marketing that, hey, I've generated power today and come and buy power from me, right? I'm never going to do that. Vis-a-vis, if you are developing if you are setting up a shoe manufacturing company, then you need to have that marketing and advertising expenses as well, right? So that is how you need to think through on what industry you're working on, and hence what kind of assumptions you will need in your financial model, right? So this is what we will have the details of the setup, right? I mean, whatever industry that you are in. Then I have my financial assumptions, how I'm going to finance this project. So in my case, I'm going to do 30% equity, 70% loan. How loan, what is the kind of interest rate for this loan? So I have built this as well. Now, I might also take short-term and long-term loans. Typically for construction, there is a different interest rate. So construction is a short term, right? 1 year, 3 years, right? Vis-a-vis long-term loans that I take. So if you have taken, or if you know your parents who have taken a home loan. Home loan typically is a 10, 15, 20-year loan, right? It's a long-term loan. So the interest rates for that are different from, say, short-term loan, right? If you're taking an education loan, for example, that interest rate will typically differ. Similarly, in this project financing also, the construction loan and the long-term loan, right? The interest rates could differ. So I might choose a mix of short and long-term loans to finance my project, and hence I have taken all the details into this factor, right? All the assumptions I've put in, and in my loan sheet I will be calculating all this, right? Then the revenue assumptions, right? I'm going to sell power. So year on year, how much power I'm going to generate, and what is the unit rate for power? So this, now where will this assumption come from, right? So here in the assumptions, right? Assumption, I mean, the number is one thing. What's the backup of the number? So this number has come from a MOU that I have done with a power purchasing organization, which is a distribution company, or it could be a industry which is going to buy power from me, right? So I have a, before the project is finalized, I do certain MOUs, right, with different vendors. Even where have these costs come from? The solar modules cost. With a vendor, I have done a MOU, in principle tie-up, that you're going to sell me models for this cost. The moment I get my financing, I will be paying you, right? So all the assumptions should come be as real as possible, right? And that is where your model will also give you accurate results. Then, so these are my revenue assumptions. That so revenue basically it's power. So what is the rate that I'm going to sell power for, and what is the number of units that I'm going to generate the power. Now here, at that time, we had something called as renewable energy certificate, right? Because solar is renewable energy, it takes more time to, more cost to generate the power, etc. So there was I mean, I can, also sell renewable energy certificates. So this was an additional revenue stream for me. Now this market has collapsed, right? So you need to be cognizant of how the markets are to build these assumptions. Then another revenue stream for me was carbon credits, right, which is still there. So that is an additional revenue stream which I have built, right? Then are my operational expenses. So some of the cost you might have, right? If I do a MOU with a vendor who is going to do the operations and maintenance for me, I would have it that if per year I'm going to spend 3 lakhs rupees on O&M, right? Then I can put that as a cost. But at the time of this project, the vendor who was going to sell us the solar modules, he had told us that typically for the first year, you will need 0.25% of the project cost as your O&M cost, which is a fair assumption in this industry, right? So hence, you become an expert in the industry, right? And then when you start modeling all of this, right? Because now you know, right? I mean, what works on the ground, right? Then escalation. So every year, I mean, every year things escalate, right, at a price. So both your revenues will also escalate and your expenses will also escalate. It is better to err on the side where you take safety factor, right? Escalation instead of 5%, I will look at, what is my my inflation indexes, and also I can index it accordingly, right? So from an internal perspective, it is better to take this on a higher level. But when you're going to an investor or to a lender, you don't want to show it very high, right? You don't want to show very high expenses, right? There you can take something which is accepted by the industry, right? So there could be O&M, then there are insurance expenses, there is some level of power consumption on the site, there are grid access maintenance fees, bank fees, administrative expenses. As I said, no marketing expenses for my power project. So these are, I mean, you can figure out what are the different expenses that your industry will have, and hence what are the assumptions that you need to take. As I said, it could be a percentage of something, or it could be a hard figure which you can put it over here. Then there are different tax assumptions. So there could be an income tax rate, which the IT is going to charge you. Then if you have to pay a minimum alternate tax, then that is another rate. Then MAT credit, I will take you through what this is. And as I said, right, because this is an infrastructure industry, it also has a tax holiday. So, am I going to avail this? Again, I've created an option. If I say yes, something happens. If I say no, something happens, right? So, all this Y and N is linked internally throughout my financial model, right? You change one of this and it will impact everything, right? So these are some binary inputs that you have for your project, and these are the numerical inputs that you have for your project, right? Then there is depreciation. Now, because again it's infrastructure, the IT law enables 100% depreciation. Again, depreciation, I mean, those who have been studying accounting and finance, you know that, right? I mean, typically land is the only asset which is not depreciated. So out of the total project cost, you need to reduce the land cost and then depreciate other assets. Also, there are different rates of depreciations for different types of assets. Your building will have another rate of depreciation, your computers have another rate of depreciation. You need to take all of these into account. For simplicity purpose, you can give one rate, which is okay at a level where you are in the fundraise process, right? Or where 80% of the asset is one specific asset and 20% are the remaining assets. Then also it's okay to consider one depreciation rate right now. Okay. Then, as we had mentioned yesterday, so this is a model, right, which we had built for USD as well as INR, right? So we have used different currency exchange rates also, which are also inbuilt into the model. And here also, again, I have a choice. Am I using USD? Am I using INR? What kind of multiplier that I'm using for the model, right? So this is the assumption sheet. On the assumption sheet itself, I have put some of the outputs. Again, as I said, you can put this on the cover page also or in a result page. Like, I wanted to put this over here because I want to see that if I change some assumption, how does it impact my IRRs, my project IRR, my equity IRR, and how does it impact my DSCR? DSCR is nothing but debt service coverage ratio, something which is required by all the lenders, people who give you loans, right? So this is what I put it here so that it's easy for me to see the outcomes based upon what I'm changing in the assumptions. Then next we go to the project cost and means of financing. Okay. Let me remove all this so that it doesn't distract you. But I will also tell you. So what you can see all these blue arrows, right? So these blue arrows are to help you track a formula. Okay, I will just show that to you. Let me go to say P&L. Okay, and I have something called as total income over here. Now there is some formula here. Now here it is quite simple, right? D11 plus D14. So you can easily say acha, D11 is this income from energy and D14 is this income from carbon credits, which is easy, right? Now let's look at something which is, now for example here, right? Now here, okay, let's take an example of this, right? Where I have two inputs coming in from the assumption sheet, D29 and C62, right? Now, if I want to figure out where these are coming from, I use something called as trace precedence. What is coming into this cell? And if I click this, it will show me these two things. If I click on this, it will take me over there. See, it has taken me to D29. So I now exactly know that from assumption sheet which cell am I coming over to this sheet. Similarly, if I click on this, it will again take me to what is it that I'm what input I'm using for this specific formula. So for formula checking, while building the financial model, trace precedents and trace dependents are some of the very important tools in Excel which you'll have to use, right? So let me remove all these arrows. So going back to project cost, right? So now project cost, right? Now, as I said, right? I mean, typically if I'm going to raise 100 crores, right, for my project, I won't do that on first day, right? Because I don't need my 100 crores on the first day, right? if I'm going to take 1 year to construct a project, I will need some money in the first quarter. On day one, I will need some money, right? But not all the money. I will need some money in the second quarter, third quarter, fourth quarter, right? So why am I not going to take all the money on day one? Because my interest starts kicking in, right? I don't want to pay so much interest, right? And this is something which similar, what happens to the housing and education loans that we take, right? Typically, there is something called as drawdown, right? How much am I going to draw down every quarter or every month? And hence, so for here, what I've done is I have all this, I've broken all the cost elements: land, preliminary and management, EPC, modules, inverters, frame structure, blah, blah, blah. So I've broken everything down, right? In terms of what is the individual cost. Then what I've done here is that, see, land is something that I will need from day one, right? My project can't come up, right, if I don't have the land, right? Then typically vendors, like if I'm sourcing my solar modules or any service or anything that I'm taking, right, they will typically ask for 30% advance payment, right? Some might ask 50%. So hence, for all the other elements, on day one, I said, oh, I need only 30% of the total value. Land, I need 100% on day one, and then rest all, I just need 30%. And hence, I've calculated that on day one, how much do I need? And then over the next quarter, how much do I need? So I've broken down this project cost quarter wise over here. Okay. And then, so this is now as per like what is my total cost into 30% is coming here, into 70% is coming here. Based upon that, my interest during construction starts kicking. So here, if you see, my interest is only 73,000 because I'm not drawing down everything in the first quarter. If I would have done that in the first quarter, my interest would have been this plus this starting from the first quarter, which means that I'm paying additional interest for one full quarter needlessly, right? Just because I haven't planned my finances well, right? So this is how the project cost and means of finances worked out. Now again, what also happens is that the banks say that you put your equity first. I'm going to give you loan only if you put your money first. So hence that also reduces from my total drawdown. I will first draw down from equity from the owner, and then the bank loan will kick in. Again, there could be a proportion. Bank could say, "Acha, you put in 50% of your equity, then I will put in my loan." So that depends upon what kind of clauses that you have in the contract, and that is what gets built over here. And this helps us to find the interest during construction. Now, just one interesting fact on this: interest during construction, the banks typically allow that to be part of your project cost. So it allows you to capitalize that. So what's the advantage of that? One, you can take funding for that part also, right? I mean, it's an expense that you have, right? But you're capitalizing that, making it part of the capex. So you can take interest, you can have depreciation on that part as well, right? So that is the advantage of using the IDC. Great. Now somebody had asked question, right? That how do I calculate the revenues, etc. So I'm going to take you through detail in this one of the examples, right? Now power generation, right? So let's see. This is a very complicated formula. So let us look at this, right? So let me again go to trace this thing precedence, right? So where are the assumptions coming from? What is C64? C64 is that in the first year of operation, and this is again specific to solar, right? And this is also specific to when my project is starting. So if in the first, let's say that, so this financial model is built as per the financial year, right? April to March. Now in the first year of operations, do I have 4 quarters? Do I have 3 quarters? Do I have 2 quarters? Depends on when my project gets completed. So that's an assumption that I've built in. So let's see how this works. Okay. So right now the figure here is 32,162. Okay. I'm going to change this, right, to show you that how it might change. I'm going to do it 1. So we have only 1 quarter, right? See, this 32,000 now has come to 6,528. It's quartered, right? Because now I have only 1 quarter of operations in my first year. So first year is the only year that you need to take this for. I mean, because second year onwards you have a full operations, right? It can vary industry wide also, right? In some industries, that things work only for 6 months, 8 months. Depending upon your industry, you can figure it out. Okay. So this is how I'm going to change this back to 4. So this is my first thing, that okay, that my number of quarters. Just 1 minute. This is another thing that you shouldn't do. That while you're working on Excel, so basically it is C64. Okay. Yeah. So now if this is, so C64, so what is C64? Yeah, so if C64 is 1, then I'm going to use something, right? In terms of my this thing. So my assumptions, G65, right? So what is G65? So here, if you look at this, I have a table in the assumption sheet that if I have 1 quarter of operations, the amount solar radiation will be so and so. If I have 2 quarters of and this is based upon the kind of months also, right? That is why these numbers I've taken it into assumption. So typically, if I'm starting my solar operations in the summer months, I'm going to be better off vis-a-vis if I do it in the rainy season where it is cloudy and I don't have solar radiation. So because of this, I've taken this in the assumption sheet. Or if it is shoe manufacturing, right, where it doesn't depend upon the season, you can kind of take it as quarter-wise also, right? So this is where if it is 1 quarter, then I'm going to use this. If it is 2 quarters, I'm going to use this. If it is 3 quarters, I'm going to use this. So this is the if loop, right, that I'm using in the B&L, right? If assumptions this, then this. Otherwise, if assumption this, then this. So this is how my entire first row is built over here. That what is my energy production based upon the quarters that I have. Similarly, as I said, right, the solar project needs some power consumption on site. Now this is linked to this, right? So this is assumption C46. So 0.05% of my generation is used at the site itself. So assumption C46 into D3 is I'm going to spend over here. So for cell, net energy production for cell is only this much, 32,146. Sorry guys, I have a little bad cough today. Yeah. Then next is your tariff. So this is the number of units that I have, volume into price is revenue, right? Now what is the tariff that I'm going to get? So this is a little straightforward. I have this again in the assumptions. So assumptions D29 by C62. Let me see why we have done this. So D29, right, by assumption C62. So this is for my exchange rate, right? What exchange rate? Anything that in this model that has to do with the revenue figure, I have linked this to the exchange rate, exchange rate input, so that I don't have to worry whether it is in dollars or in rupees. Here itself I can see and I can figure out what this is in. Okay. So assumption I have put it in rupees. Why? Because my contract is with an Indian distribution company, correct? Which is in rupees. So I put that in rupees, but I have a facility to convert it to dollars if I'm going to show it to, say European banks, US banks, whatever, right? So I have that option. I have the facility. So this is what is the, now this is again tariff per megawatt hour. So you might think why this is so high. This is not per unit. This is per megawatt hour, right? Which is a million hours basically, megawatt hours, right? Million watt hours, right? So this is my tariff. Then this is my, if I get any SRECs, which is your renewable energy certificates, then I have a calculation for that as well. How much money I'm going to get for each renewable energy certificate that I sell. And then hence total what is the tariff, right? So I'm going to sum both of these. Now these both are linked and hence I have included over here Carbon credits, it is not linked, and hence my revenue calculation is different over here. Okay. So I have this much, and this is my income from energy. Now this is next I've calculated my income from carbon credits. Right? Again, it is linked to how much power that I'm exporting to what is the carbon credit that I get for each unit of power that I'm exporting. And based upon this is my total income, right? So this is my income for 1 year. Now, as I said, this can be as simplified as possible. This can be as complicated as possible, based upon which stage of company that you're modeling for, what industry you're modeling for, depends upon that. So here inside, right now, questions, right? I mean, why are these cells gray and why are these white? Right? I told you, right? All formula cells should be white. Now the reason is, for the first year, many a times there is a different calculation, right? As I said, because first year could be your half operational year. There could be some, disturbances in the first year which you have taken care of by the modeling. So that is why some of the calculations for first year are different, and hence I have graded. Again, if I have to revisit the model for something, I have to make any changes. This is a key for me, right? Or for anybody else who is going to use my model, to tell him or her that the first year formula differ from the other formulae, right? So keep all of this in mind, right? Even if you have a formula, if it is different from what it is seeing in the other column, so this model is built for almost 25 years, right? So build all of this, right? I mean, do this coloring right at the beginning. Otherwise, it gets very complicated later on. You won't be able to figure out what is what, right? Then there are expenses. And again, for the first year, I have a different expenses. So expenses, as I said, so expenses 0.25% of project cost, right? So you should have C44 into project cost. I'm going to take it from project cost and MOF. So I will go over here. So you can see this project cost. I don't know whether this is visible, but you have to see this formula. How do I? Is there a way that I can increase this? No. You can see the formula over here. Project cost into assumptions, and then again there is some pricing assumption, and then divide by 4. I mean, depends upon what you're looking at in the first year, right? So again, this is a first year different formula. Going forward, so typically what also happens is that first year you calculate, and next year onwards it's just an escalation, right, of the first year, and hence you don't need to calculate again and again for the first year onwards. Like typically operational expenses is something like that, which you calculate for the first year. Next year onwards, it's just a 5% escalation, right? And hence your formulas could differ. That okay, this into whatever 5% plus, right? So for every type of an expense over here, there is a different calculation, right? I'm going to share this sheet so you can have a look at that as well. Then based upon that, we have our Ebitda margins, right? So this is my net income minus my expenses. So this is my EBITDA, and Ebitda margin is very good at 73% because solar power project, right? I mean, not much expenses. Once you set it up, the expenses are very few, right? But then we have the depreciation, we have the interest that we have to repay on the loan, which comes over here. So we have the depreciation, which is coming from the depreciation sheet, interest on loan, which is coming from the loan sheet, right? And then we calculate the PBT. Income tax, again, as I said, we will take it from the tax sheet, and I will take you through what all is done over there. You calculate the PAT, and then this is something which goes to a reserve and surplus. So this figure goes and sits in your balance sheet on a year-on-year basis, right? Any questions so far? Okay, so can you, okay, Kaushal has a question that can you please give a quick recall what financial model is and what it is used for? I think, let me reiterate it. So typically financial model is used as a decision-making tool, and it is very important for all sorts of finance careers as well as some non-finance careers, right? Such as strategy, business development. As an example which I had given, I had used financial modeling for marketing ROI calculation as well, right? So it is something which is used across in businesses. Tarun has a question. My question is, in corporate, should we have a knowledge to make a FM or specific industry or diversified industry? See, knowing how to build a financial model, right? Once you can make it for one industry, you can make it for other industries also, right? So that is not an issue. So once you get a hang of how to build a model, right? Assumptions, the structuring of the model, and how to tie up all the things and how to use it for decision making, right? Then you can, I mean, build models across. I mean, you can build it for tech, non-tech, infrastructure, any kind of industry. Harshan, $2 million expense assumed. I don't know what in what this thing, but yeah, there are a lot of assumptions, and this is a big project, right? So the expenses are big. Cool. Any questions? Any doubts, queries so far? Yes, Akshit, I will be sharing the model. I hope all of you are there on the WhatsApp group. So we will kind of, help share the model through the WhatsApp group. So if you're not there on the WhatsApp group, we will share a link with you and you can join the WhatsApp group. Marketing expenses in a new project. What's the question, Harshan?
Ma'am, ma'am, as you have asked, what is the marketing expense in new project?
Huh.
That's what the answer is, which was I was assumed.
Okay. So what I was trying to communicate is that based upon the industry, you derive your assumptions, right?
Yes, ma'am.
Yeah. So because this is for power industry, which is a utility which doesn't need marketing, I haven't assumed any marketing expenses, right? But if you are in an edtech industry, then you will now have a lot of digital marketing expenses. If you are in an education industry, right, where you are building a college, classrooms, and all that, then there will be a lot of branding and physical marketing expenses, right? You would conduct conferences, webinars, etc. If you are in the food industry, let's say that you want to build a model for a restaurant, right? Then again, there will be a lot of marketing, right, which will be involved in that, which will be localized marketing, right? Because your restaurant will typically attract you over here. You might want to list your restaurant on Zomato, Swiggy's, then there would be the commissions that they charge, which will come as your expense, right? So all these things you need to model based upon what industry and what stage of company that you are in, right? So
Okay, ma'am.
hence assumptions is very critical for any financial model, right? Great. So let me quickly run you through one more sheet, right? And then,
Ma'am,
yes, Rohan.
can you teach us like how to calculate those PL and everything?
Yeah, so PL is what we just saw right now, right? Where we calculated the revenues, right? And revenues were based upon the number of units generated into the price that we get, that is the revenues. Then we reduce the expenses, whatever we are incurring to generate that revenue. And then we reduce the depreciation, interest, amortization kind of expenses. And that is how a P&L gets generated. Is that clear?
Okay, ma'am. And there was a lot of things that there were different kinds of terms, and I didn't know how to calculate that.
Sure. Can you tell me any specific terms that I can take you through that?
Like EBITDA, profit before tax, and PAT margin.
Sure. So EBITDA is nothing but earnings before interest, tax, depreciation, and amortization, right? So it is basically nothing but your total income minus your total expenses, right? That is your EBITDA. If you look at this, it is simply D16 minus D27. This is also called as gross operating profit, right? How much expenses are you doing to earn your revenues, right? That is what comes from your EBITDA. Okay. Also, do one more thing. Go through the other material that we have, right? The first workshop that we did. So, what is EBITDA, right? I mean, that's the first question, right? Do a course on basic accounting to find out what is EBITDA, what's the significance of that. Then you find out PBT, right? Where it is profit before tax, right? Then what are the elements which come between EBITDA and PBT, right? So again, see if you do a basic accounting course, I can share a few links where you can do that to understand these terminologies. Okay,
Yes, ma'am. It will be helpful.
sure, we'll do that. Great. So I will quickly run you through, let's say, a depreciate. So depreciation. So what is depreciation, right? Typically, once you're building, let's say, a solar project, right, or any large infrastructure, or a building even, right. So once you build that building, after it has a certain life, right, 5 years, 10 years, or any asset, any physical asset has a certain life, and you need to keep investing your money so that after the life of that building is over, you have enough money so that you can build that building again or build that asset again, right? That is how the entire depreciation part has come. That it is a capital expenditure, right? Building a building is a capital expenditure. How are you going to show it in your year on year financials? By saying that for rebuilding this asset, I will be keeping aside X amount of money every year so that I can rebuild that asset over a period of time. That is what the tax and the regulation authorities say, that this is what you need to, and that is what depreciation is about. The asset is going to depreciate. Are you showing it in your financial statements? Right? That is what the whole idea is. Now, where do the complications rise from? Right? The complications rise because the depreciation, the percentages. So if you look at this, as per company law, so this is the Indian Company Act, the depreciation allowed by the company is 5.28%. But because I am an infrastructure company, income tax, right, which wants to promote infrastructure building activities in the country, they say that you can avail 100% depreciation. What is the benefit for me as a project owner, that I am able to benefit, avail 100% depreciation? That means that in the first year itself, I am showing a loss. If I am showing a loss, let me take you to the P&L. Depreciation, if I'm showing a loss, so this is a lesser loss right now. If I'm showing that, then the tax that I have to pay out is less, right? That is what helps me as a project owner, right? Now there have been, misuses of this as well, right? So to give an example, right, for like government was promoting wind power projects, right? Now, and they were giving 100% depreciation. So a lot of people who had profitable operating businesses, they started developing wind projects. Okay, left, right, and center. They took money from banks, they took money from equity investors, and they started building wind power projects. All the money that they took, there was a windmill, but then when the auditors came and saw it, there was no generator inside the windmill. So the windmill wasn't generating any power. It was done just so that the business can take the depreciation effect and pay lesser taxes. The money was channelized into existing businesses, right? So there are misuses as well, and then kind of it helps recover over a period of time. But the government has the intentions of developing this infrastructure in the country. That is why they have given 100% depreciation, then they give tax holidays, etc. So the depreciation also, the way income tax asks you to calculate depreciation is as per the return on value method, right? So hence, if this is the depreciation, then now there here they have mentioned as 100%. So again, this is coming from assumption. Let us change it and look, right, what it looks like. So C57, if I go to C57, let's say that my depreciation law, as per IT Act, it is 50%. Okay, then this whole my depre will change, right? If we look at this, it is now 50%, and hence the depreciation over a period of time also changes, right? So this is how the depreciation sheet is calculated. Basically, what is the asset value at the beginning of the year? So let me also show it through the Company Act. The opening balance asset value, any asset addition that I am doing, closing balance, right, which is basically nothing but opening plus the addition, that is the closing balance. Then how much is depreciated? So this is nothing but the closing balance into this percentage, or it could be also opening plus closing ka average into this percentage. That is my depreciation, accumulated depreciation. Now this accumulated depreciation goes to your balance sheet, right? That the asset value on your balance sheet keeps on decreasing year on year, right? That is why so like there is a gross asset and a net asset. People who have read accounting, you would understand this. Now, nothing. It is nothing but gross asset minus accumulated depreciation is the net asset, right? So your depreciation is calculated year on year, and then your asset, if you look at the closing balance, right, that goes on decreasing, right? And this is your accumulated depreciation over here. So this is how your depreciation is calculated over a period of time, and then this comes into, again goes back to your P&L. Then there are tax calculations. Again, as I said, for the tax calculation, you need to consider the depreciation regulations. So here I am adding the depreciation as per company law and reducing depreciation as per the IT law. Because if I have to pay income tax to the income tax authority, I need to take care of their rules and regulations. And hence, or you can simply start by Ebitda also, right? And you can start from here also. But for the ease of building the financial statements, I've started from PBT. Then this is my taxable profit. Am I making any losses? Then I don't need to pay tax. That is how all these calculations are designed, right? Then what is my profit before any losses? Am I availing? Now this is the 80IA, the holiday benefit. Now again here, what they say is that you can have a 10-year tax holiday, but you should avail it within 15 years. So this is how much I'm doing a counter over here. I've built a counter. Am I in the first year of my operations? Am I less than 15 years, right, in my total operation? So you can see over here, right? Is it greater than 15? Is my first year greater than 15? Is my first year less than 10? If yes, then the counter will be on. If no, then the counter will be off, right? So this is how the count. You need to build several counters for all of this, right? So see, my counter is starting here in the 9th year. So because before that I'm making losses only, right? If I'm making losses, then I don't need to pay. If I'm making losses, then I don't need to pay tax, corporate tax. I still need to pay the minimum alternate tax, which is again mandated by the IT, right? And hence I'm not availing any holiday over here. Even if I avail holiday, right, because I'm making losses, it's of no use to me, right? So here, only the 9th year, when I'm becoming profitable and I'm eligible to pay the tax, the full tax, then only I will start availing the holiday, right? So this is how you need to build your tax sheets. Then what is the now minimum alternate tax, right? So this is basically the income tax has said, right, that you need to pay a tax based upon your Ebitda, right? That's the minimum alternate tax that you need to pay. But they give a credit facility. Let's say that I'm paying 10 rupees tax today, right? And I'm not eligible for paying taxes this year, next year, and the year after that also. So my 10 years is in credit with the income tax authority. Next year, minimum alternate tax, again I'm paying 10 rupees. Again, third year I'm paying 10 rupees. 30 rupees it's with the income tax authority. Fourth year, if I'm eligible to pay taxes, and the taxes that I have to pay is 25 rupees. 30 rupees, which the income tax authority already has, it will give me a deduction. So again, I don't have to pay anything because I can do 25 minus 30. So 5 is what I have to pay. Again, it will keep it as a credit. They won't give it back to you. They will keep it as credit, okay, with them. And that credit also has a limit, right? That you can keep this credit max for 10 years, right? So all this they have done basically to avoid, kind of detract those who are avoiding taxes and all of that, right? That is why this complicated calculations come in, right? So I have done this, right? Where I have also computed the MAT credit, right? That every year, how much MAT credit do I have? Am I eligible to pay tax? If I am eligible, then how much credit can I avail, and hence how much tax I have to actually pay out, right? This is the entire tax sheet, how it works, right? And so I've taken you through depreciation, tax, loan. I will just quickly run through it. It is pretty simple. What's the opening balance? How much you are paying every year? What is the balance amount and what is the interest, right, for that specific year? Again, as I said, loan can be for a customized loan schedule, or here I have something called as annualized loan repayment schedule, which is a standard one, right? That every year from a specific, after the moratorium period is over, I start paying the loan. And hence, what is the, if you go through this formula, it is simple, right, in terms of the loan calculations that you have, right? Then I calculate, then we go to the cash flow. That typically here it's only two sources of cash that I have, which is equity and debt drawdown. and the cash from operations, which I'm generating every year, year on year. And hence, this is my source of cash. Where I'm using the cash, so all the equity and debt I'm using only for capex, and I'm using also the cash to pay off my debt repayment. Right? Expenses and all that, obviously, it is taken care of in the cash from operations, right? So I'm not doing any investments here because it's a project financial model. There is no cash flow from investment activities and all of that I haven't considered, right? So cash flow from financing activities, cash flow from operations activities is what I have considered over here. Balance sheet, again we need to balance what are the assets that we have, what are the liabilities that we have, all coming in from the projections that we have built, right? Then returns. So as I said, from the cash flows, we go on to build the free cash flow to the firm and the free cash flow to the equity. I will share the formula for that, and then you can use this to understand the formula and how it comes into the model, and then you calculate the returns, right, based upon what rate that you're looking at. And then, as I said, you create your IM info and lenders presentation sheet. I will just quickly take you through some quick possible interview questions, and then we can discuss further. So typically on financial modeling in interviews, right, what do they ask? It is majorly on assumptions, right? Why are you taking these assumptions and how it will impact your model, right? So assumptions is something which you should be very clear about. Have a reality check on what assumptions you're using, why you're using. Is it as per the industry? Is it as per the company stage? Everything. Second could be on sensitivity of the models, right? I mean, typically what happens is that sometimes a financial model could become sensitive to some one specific input parameter, right? Now that is something which you want to avoid when you're building out the model. So have you run different scenario analysis? If your interest rate increases by 5%, decreases by 5%, if your revenues increase by 5%, decrease by 5%, what are the outcomes? What are the results for your financial model? Have you done that kind of a sensitivity analysis or a scenario analysis, and see what are the parameters to which the model is most sensitive to, right? So these are some of the things which you could be asked about. There are obviously some Excel tools and tricks, right? So typically there are a lot of Excel formulae, right, which are inbuilt, which helps you to financial model. Also, one thing, right, which all the expert financial modelers tell you, right, that you shouldn't be using your mouse too much. You should be adept enough to use all the keyboard shortcuts, right? Because it's a huge activity, right? And building out one financial model, right, takes whatever 2 weeks minimum to even 2 months, right, depending upon the complexity of the model. So you should be adept enough, and you need to test the model, right, all the time, right, whether it is giving those outputs, etc., right? So have that command on the keyboard, have that command on Excel shortcuts, and know a lot of formula which are inbuilt in Excel. Objections to the model. Typically, clients will come and say, "Acha nahi, ye nahi chalta hai. This is something which is wrong. How come you're showing very low profits to us?" Clients don't like that, right? When you show them the real picture, right? So, are you able to, as a financial modeler, are you able to do that client objection handling? Right, is something which you would like to check during the interviews. Great. So that kind of brings us to the end of this workshop. As I mentioned, we have quizzes running, and for every quiz that you play, you get a certificate, be it on financial analysis or valuation methods, or today's quiz on investment banking. This is again a little bit on the Finathon. So we have all the quizzes open: financial analysis, valuation methods, and investment banking. All the workshops recordings are available. If you don't have it, ask for it. We are there on the WhatsApp group to answer all of your queries. Some of the good resources. So again, what I had shared last time, right, that is all good. I mean, you get an idea of how to build, what is important, and all of that by reading, right? So Investopedia or Wall Street Mojo, or from CFI, or from the online courses. If you go to Coursera or edX and just search financial modeling courses, excellent courses are available. However, the most and the only important resource is practice. If you yourself don't build a model hands-on, then nothing is going to help you, right? So this is the best thing that you can do if you want to become an expert in financial modeling. Practice it out yourself, right? And we are there to help, right? I mean, if you need any feedback, anything, we are there to help you on that. Great. Thank you so much. Any questions? I can take a few questions. Are there any questions? Cool. So if there are not any questions, what you can do is we can, okay, where can we practice financial modeling? Very good question, Akash. So as I said, right, one is we will share this model with you. You can go through this and start building. Try to first replicate the given model. Simple, right? Take a financial model and open your Excel on your laptop and start building that, right? So first replicate a given financial model to see whether you can build and your outputs come as per the original financial model. First step, do that. Second step, then you can kind of start probably doing an internship opportunity somewhere where you can assist in building the financial model, right? That's the second step. First is practice by on existing models, right? Start from scratch, open a fresh Excel and start building. Great. So we will be sharing all the recordings and the financial model as well. If you're not part of the WhatsApp group, then please join the WhatsApp group. We will share the link over here. Team, can you please share the link to the WhatsApp group so that there we are solving queries on a regular basis, and we will be sharing a lot of resources on this group as well. So you can be part of that and access this. Any other queries or any doubts that you have, feel free to ask over there. Yeah, so the link is shared over here for the WhatsApp group. You can communicate through this, and any doubts that you have, you can ask over there. I hope you guys enjoyed the session. Financial modeling is a very, very, very important skill set, right? I mean, to give an example, for the final interviews that I had, right, and I'm Ahmedabad, the only question which was asked to me is that, are you able to build a financial model, right? And since I had done that in my internship and also done that multiple times in my course, in my M&A courses, right, merger and acquisition courses, right, where every case study we had to build a financial model. That really helped me, right, to crack the interviews because I was having that confidence. Having said that, I mean, every industry, every kind of company is different, and every decision that you have to help make is different, right? So you kind of build that expertise when you keep working on it, right? So do that. It's a very exciting, very exciting work, right? Where you can see, how your assumptions impact clients' decision making, right? And that's very exhilarating. Great. So thank you so much for being on this session. And any help that you need, I mean, feel free to reach out to me through the WhatsApp group. And we will connect again for more workshops on finance. Thank you very much.